Hi, this is Nicholas Vardy, and welcome to this week's edition of Buy or Buy. In this series of videos, I take a popular stock making the media rounds, I strip away all the hype, and let you know whether you should buy now, buy later, or buy never. Today, I want to take a look at Apple, which is one of those stocks that never seems to leave the limelight. With the company announcing earnings on October 28th and the stock pulling back sharply over the past month or so, it seems like it's a good time to revisit Apple stock. So let's start with the numbers. Wall Street analysts expect Apple to report earnings of $1.23 per share for the current fiscal quarter. Now, Apple reported earnings of 73 cents per share in the same quarter last year. So the market expects positive year-on-year growth of 68.5%. Of course, this growth rate is flattered by 2020's post-coronavirus low base. Analysts also expect Apple to report full-year earnings of $5.59 per share, with EPS estimates ranging between $5.41 or $5.64. Now, Apple is probably the most covered stock in the world, and you'll find all sorts of conventional ways of looking at it. In a traditional analyst report, you'll hear about the iPhone 13, about its memory capacity and its new cameras. You'll also hear about Apple's ever-expanding ecosystem, which includes the Apple Plus TV service with actually a pretty funny show called Ted Lasso, won several Emmys in the past month. But you'll also hear about bad news about Apple. You'll hear about the lawsuits against Apple. Recently, there was a $95 million settlement in Canada. The EU is launching another investigation into Apple based on its NFC chip technology. Apple recently had a slight setback in terms of its App Store, where it now has to put an alternative payment system on the App Store. But again, these are just kind of pinpricks on a behemoth, on a $2.4 trillion behemoth, and really don't make much difference to Apple's long-term prospects. Today, I really want to talk about what makes Apple special and why I think Apple will continue to fare well in the coming years. Now, trading at 27 times forward earnings, no doubt Apple is no longer the bargain that it was a few years ago, back when it was trading at half that level in 2018. Now, looking at the numbers is one thing, but there are many reasons to think that Apple will remain a safe investment. And these have everything to do with Apple's moat, its long-term relative position in the marketplace. And here are three ways that I think about Apple's moat. First of all, Apple's products are addictive. Now, you may not think of your Apple device like tobacco or heroin, but checking your iPhone triggers similar dopamine receptors in your brain. And there are thousands of very smart PhDs in Silicon Valley trying to make Apple products as addictive as possible. In a recent study by Psychology Today, 94% of participants reported feeling troubled when they didn't have their phone with them. Another study found that half the participants would rather have a broken bone than a broken phone. And investing in a company whose product is addictive, well, that makes a lot of sense no matter what today's financial statements tell you. Second, Apple locks you into its ecosystem. Now, I live in Europe and I see China's Huawei phones all the time. And frankly, they're at least a generation ahead of Apple's. They're slicker, they've got better specs, and they've got brighter screens than my iPhone does. I could go out and buy one today, but between my computers and Apple TV, the cost of switching out of the Apple system is just too high. Like the Hotel California, you can check out of Apple anytime, but you can never leave. Third, there are always buyers of Apple stock. So let's start with Apple itself. Apple actively buys back its stock, which acts as support for its stock price. And here's a statistic I came across today, which is quite remarkable. Since kicking off its repurchase program in 2013, Apple has spent $327 billion to buy back 2.5 billion shares with an average price of $131 per share. That's a remarkable amount of money. Add to this the rise of passive investing, which ensures an almost endless demand for Apple stock. That's because most benchmarks are weighted according to market capitalization. As long as flows into passive funds continue at the current torrential rate, there will always be buyers of Apple stock. Now, I can't predict the future, but I can say with confidence that Apple won't double in the next 12 months. At the same time, it's also not going to go the way of BlackBerry, and I expect it to be around for a long time. If you own Apple, I recommend you consider it part of your never sell portfolio. But if you want to bet big on Apple, the recent pullback is a good time to do it. My verdict? Apple is a buy for long-term investors looking for a safe blue chip stock with a growing business and an addictive product. But act quick before the stock bounces out of its current correction territory. I hope you enjoyed this episode of Buy or Buy. If so, please hit the like button below. And if you want to follow any of my buys or sells, size your position accordingly, set a trailing stop, and never bet more than you can afford to lose. And if you'd like more of my financial insights on stocks, trends, or money in general, be sure to sign up for Liberty Through Wealth, a free e-letter I edit at the link below. Thanks for watching, and see you next time on Buy or Buy.